Good morning, everybody. Thank you very much for joining us here for our BPR planning to maximise release before the April 2026 changes.
Good morning, I'm Toby Hermitage. I'm one of the corporate tax partners here. And whilst corporate tax is not directly relevant to BPR, one of the things that I do a lot of is corporate structuring and valuation work, which will be. Michaela, on the other hand, is a private client tax partner with a particular specialism in inheritance tax and trusts. And you will see why those things are both particularly relevant as we move forwards.
Fantastic. So we've got a packed agenda this morning. We will be aiming to get this done in time so that we can have some Q&A at the end. It would be great if you've got any questions, though, please pop them in the chat and we will try and pick these up. Anything we're unable to cover during the course of the next hour, we will try and come back to you. So if you've got a burning question or it's very specific, pop your email address in the chat as well and we'll help with that. So what are we going to cover? We're going to look at what has been changing. It's hard to escape what's changing because there's been plenty in the news. Mr. Clarkson, for example, has been incredibly vocal about this. So I'm sure you're all aware of what's happening. You wouldn't be here otherwise. But we are going to look at an IHT refresher first for those of you who are not doing this day in, day out, just so that you're aware of what the current rules are and how it works. We'll look at the changes and then we'll look at the impact. The bit I'm sure you're all interested in is what can be done. So we are going to look at some of the planning techniques that we've been helping our clients with over the last few months since the rules were suggested or changed or announced. And then finally, we will move into why business valuation is important because suddenly it has a whole new relevance, doesn't it?
Yeah, it's become a growing facet of what we do is looking at valuation particularly for inheritance tax, where it used to be going back 4 or 5 years. It would be a lot to do with share schemes. It would be a lot to do with issuing shares for growing companies. Now we are caught up in doing an awful lot of valuation for death estates, 10-year charges, and all manner of other things that link to the changes that have been made here.
And what is changing? Okie dokie. Okay, we'll start with the inheritance tax refresher. Inheritance tax is a tax that is paid on the estates of individuals at death. It can also be paid by various relevant property trusts. By relevant property trusts, I mean most modern trusts. So if you've got a discretionary trust, then it's going to be a relevant property trust in all likelihood. If you've got a newer version of an interest in possession trust, so post 2006, then that too is likely to be a relevant property trust. The inheritance tax is paid by either of those. Some offshore trusts also pay inheritance tax where they own UK residential property, either directly or indirectly. Inheritance tax for those who have deceased has been static since 1984 at a rate of 40%. Now, it's not changed in a very long time, but we do have a budget coming up. And every time there's a budget, there are always rumours about what is going to change. I haven't heard any rumours about the rate of inheritance tax changing, but you never know. So please take that as a health warning. Everything we're going to say today is based on what we know today and could potentially change.
The one thing we are fairly sure of is that none of these rates are going down anytime soon. If they are going, they're only going one way, and that is up. Times are hard. We do need to think about particularly the market value of the assets. It's become increasingly important because we need to understand what the potential exposure is now and how that will change over time.
Absolutely, because inheritance tax is payable on the net value of the estate, which is the market value of all the assets, less any debt that's secured on them. In addition to that, if you're looking at the death estate, you also may need to consider gifts or settlements made in the previous 7 years of life, so what we call potentially exempt transfers. You've also got something called the 14-year backward shadow, which can affect those who have settled trusts, not only in the last 7 years, but where there are settlements in the previous 7 years to that, so in the last 14 years. That's outside the scope of what we're talking about today, but just something to be aware of. So inheritance tax in the UK is paid by long-term UK tax resident individuals on their worldwide estates. Now, this used to be the concept of domicile, which has been scrapped earlier this year. By long-term tax resident, we mean somebody who has been living in the UK for the last 10 years or the last 10 out of the last 20 years. Those who have been out of the country for at least 10 years are no longer considered long-term UK tax resident, and those who have not been here very long will also escape that term. Even so, when they die, they will still suffer UK inheritance tax on their UK situs assets. In both cases, this could be affected by the double tax treaties, but as there are only about 6-7 double tax treaties with the UK that affect inheritance tax, you can assume that in most cases, inheritance tax will be payable on UK situs assets for UK long-term residents on everything. Can also include that when you're calculating the value of the death estate, life interest in certain qualifying IAPs. Now, what I mean by that is the old-fashioned interest in possession trusts, so those pre-2006. So tax is payable when the event happens within 6 months of the end of the month. So if you're looking at a 10-year charge that was on the 26th of June, then the liability kicks in at the 31st of December following that. On some assets, it is possible to pay tax in 10 annual instalments. If you've got residential property or you have got unlisted shares, for example, and there's inheritance tax due, then it can be paid at a rate over 10 years. HMRC will charge interest currently on that, and that is at a rate of 4% above base. So that's pretty nasty. It's about 8% now, something like that, 7.5%, 8% now, depending on what the government have done this week with the interest rates.
So there will be a calculation to do there. Is it cheaper to actually borrow the money? Can you finance it through existing resources or by leveraging other assets? I've certainly heard talk, among some of the larger clients I deal with, potentially putting second charges on homes or remortgaging houses that have had the mortgages previously paid off.
Absolutely. HMRC are no longer a cheap lender. They used to be. The rules have changed relatively recently because it used to be 2.5% above base, but now it's 4%. So it's quite a lot. If you sell an asset which you are paying annual instalments on, then the tax becomes payable immediately if the asset is disposed of. I was once told many years ago that inheritance tax is a voluntary tax, i.e. if you do the right planning, you don't need to pay it. I'm not sure that's necessarily true, and we do not have a magic wand to try and solve the problem, but what we do have in our arsenal is quite a lot of reliefs that are useful for inheritance tax planning, and we use those when we are doing that sort of planning. So the really basic one is the nil rate band, which is currently £325,000. That is the tax-free bit of the first bit of the estate, which is tax-free, whatever you've got and wherever you're living in the world. That has been static for 15 years. So it's a bit of a stealth tax. As the price of housing and assets have gone up, this has not changed. So this is one way the government have been kind of increasing their take a little bit just because of this. We also have something called the transferable nil rate band. Now, what that is where a married couple leave assets to each other, or they don't use up the nil rate band, or the person who's deceased hasn't used their nil rate band for whatever reason, it can be transferred over to a surviving spouse who can then use that on their estate. So this is relatively common because in most wills you'll see that the person who's died will leave 100% of their estate to the survivor, who will then leave it to the kids, for example, on the second death. And this is where the transferable nil rate band comes in, because the survivor then, instead of having 325,000 tax-free, they can have 650. You've got the residential nil rate band too. This was introduced a few years ago. This is worth £175,000 if you qualify for it. There are quite a lot of restrictions on this one because it can only be used on property. It can only be used if you are passing it to a direct descendant, so kids, grandkids. So if you're like me with no kids, I don't get this. You can only get the whole amount if your estate is worth less than 2 million. And if it's worth more than 2 million, we start to taper it away at a rate of £1 for every £2 you go over. Now, this forms quite an interesting piece of planning because it is, again, these are transferable between spouses, but it does mean that it's quite helpful to try and restrict the value of the survivor's estate to less than 2 million by making perhaps gifts on the first death. But again, just planning that we look at.
That was the response to cries of the 325 has been static forever. House prices have gone through the roof. So they brought this in and then found a number of clever ways to disapply it so people don't get the full benefit of it.
I'm not sure that was the aim, but yes, we'll see, maybe. The idea is that a married couple with a property and an estate less than 2 million should be able to qualify for a full £1 million tax-free release. Okay, so in terms of other relief, we've got business property relief and agricultural property relief. These are the big ones for business owners, and we are going to go into a lot more detail about those in a moment. You've also got plenty of gifting relief. So gifts for spouse are always IHT free. Gifts for charity are currently IHT free. In addition to that, if you give away enough of your estate, which is effectively 10% of the taxable estate, you can reduce the rate paid on the rest of everything that's left as going to your family, for example, down to 36%. And that can have some interesting results and provide quite some decent savings if done properly. Yep. At the moment, gifts to political parties and for national purposes or heritage purposes are also IHT free.
I'm going to place a small wager that gifts to political parties are always going to be exempt because, God forbid, we'd actually shortchange our lords and masters.
Okay. There are restrictions on this, though. For example, it does have to be to a political party that qualifies, so needs to have a certain amount of members sitting in Parliament, and it has to be to a political party. You can't, for example, there were a lot of people who got caught out when they made gifts to either Remain or Leave those campaigns. Those were not IHT free because they were not gifts to a charity and they were not gifts to a political party. They were on a campaign. So, anyway, interesting point. The big reliefs are in relation to lifetime gifting. The most commonly everybody understands is 7-year rule, where as long as you make a gift that is more than 7 years before death, it is a potentially exempt transfer, and therefore it doesn't come into charge for inheritance tax purposes as long as you survive it. If you don't survive it, it has to be taken into account when you're working out your taxes. However, there is something called taper relief after 3 years. Taper relief looks like a very kind of thing to have, reducing the amount of tax you're going to pay, but it only really works if you have made significant gifts, because you have to have used your nil rate ban first for this to be of any use to you. So unless you've actually given away £325,000 worth of gifts or settled that much, this isn't going to really apply. And I've seen that done a few times where people think that they can reduce the value of the gift. That's not how it works.
Yeah.
Other small allowances related to gifts include the £3,000 you can give away annually, £250 for small gifts, and then various gifts for marriage, depending on what the relationship is. You can also use something called gifts out of income. This is becoming increasingly popular. As long as you have got excess income and you can prove to HMRC that you've got enough to live on without tapping into your capital and you've got money left, you can give that away. And as long as you make a regular pattern of that and it becomes part of your spending pattern, that is IHT free, even if it is within the last 7 years of life. And there's a particular form that HMRC asks you to fill in to prove that.
Yeah.
At the moment, and this is going to change in April 2027, the last big relief is that there is no IHT on undrawn pensions. So if you pass a pension on, it's undrawn, there's no IHT to pay. Doesn't mean there won't be any income tax on it, because it depends on the age of the person who passed away. But at the moment, no IHT. The rules are changing from April 2027, and that will no longer apply, and these two will fall into the estate for IHT purposes.
I'm fairly sure there'll be another webinar on that at some point.
I'm sure there will.
Around this time next year to prepare everybody for that.
Absolutely. Okay, so we alluded to this earlier, but budget day is going to be November the 26th, 2025. So big date for your diary. We do not know what she's going to do. I mean, a lot of people would like it if she changed what we're now about to tell you, but just so you're aware, this is when budget day is going to be. Everything we say from now on is going to be as we understand it to be, but could change. Okay, so BPR, this is the reason we're all here today. What is BPR? Okay, so at the moment, BPR is 100% relief for shares in qualifying companies, and that includes AIM shares. Broadly, a company that is not wholly or mainly investing in stocks and shares or land and property. So it is, in layman's terms, it's a trading company. But HMRC actually define it negatively to say it is not wholly or mainly investing, rather than it's wholly or mainly trading. And it's a 50% test. You need to be careful, though, because not all assets within a business will qualify as trading. So there are some calculations to be done to make sure that it is wholly or mainly trading, and to extract anything that may be an accepted asset not used by the business.
And I think one of the key things to pick up here as well is when it says you can't own stocks and shares, you can't own land and property, that doesn't mean shares in trading subsidiaries.
Correct.
That doesn't mean the business premises you operate out of. It means things that aren't actually used by the business. So if you've got surplus cash and you buy an investment property or a buy to let or some stocks and shares or Bitcoin, then that's going to fall within the sort of not trading part of the business.
At that point, it needs more careful consideration as to whether or not the relief will actually apply, or whether it will apply to everything.
And there's also the possibility then that you'll look at that and go, you know what, there's probably a bit of a restructure we can do here to take it out, move it somewhere else, make sure that it doesn't fall within the scope of the taxman's grasp, at least for IHT purposes.
Absolutely. Restructuring can be key if you've got a mixed portfolio of what's in a group, for example. So the other assets that will qualify for business property relief are unincorporated trading businesses. So sole trade, if you've got assets within the sole trade and that has value, then that will qualify. There's also controlling shareholdings in quoted companies. Now, usually we're talking about unquoted businesses when we talk about qualifying companies. But controlling shareholdings in quoted companies do also qualify as long as you've got 50%. Now, I don't have any clients who have got a controlling shareholding in a quoting company. I don't know about you either.
No, I've met one or two over the years, but again, it's a very rare thing. And I suspect that for most of the people on this webinar, it's probably not going to be that relevant. Obviously, the key one is going to be shares in qualifying companies, because business owners are going to bear the brunt of this.
Okay, so the other one we've got is assets used in a company controlled by the individual or where they were a partner, but that the asset wasn't actually in the business. Now, we see this most commonly, for example, if an individual retains the property. So you've got a factory, a trading company, the individual shareholder has retained the factory, but the company uses it. And those circumstances, as long as the individual or individual and their spouse, to be fair, controls the company, then the 50% relief for VPR applies at that point.
And one of the discussions that we've been having for years is, if the individual owns the trading premises, should it be in the company? Should it be in the group? Or should it remain in personal ownership? And, this is one of the things that gets weighted into that evaluation.
Absolutely, absolutely. In all cases, though, there is a 2-year minimum ownership position, and this is going to be important later for some of the planning we're going to look at. What is changing? New rules in 2026. 100% BPR and APR will only now relate to the first £1 million of the value. Now, this is a combined relief, so this is your APR and BPR together, well, qualifying assets together. You do not get a £1 million allowance for BPR and a further £1 million APR allowance. It is just 1 million. On top of this, which is really important, it is not going to be transferable to a surviving spouse. So most of the other reliefs we have, for example, the nil rate band and the residential nil rate band, they are transferable to a surviving spouse. This one is not. There's a lot of upset about this. I know the CIOT and the ICAW responded to HMRC to say this was unreasonable, but they did not change it. On the excess zone, if you've used £1 million up, you've still got assets in your estate, then it will be a 50% rate of relief applying to the balance. So, i.e., it's 20% tax. So instead of paying 40% tax, it's 20% tax. HMRC, the government have said that it is going to be possible to pay this over 10 years and it will be interest free. So that's an interesting move, because on everything else, they charge a hefty rate of interest.
I think probably the thinking there is, for a lot of private companies, the money is in the company, that's where the profits are being generated. Therefore, people will take out a dividend, pay the tax on the dividend, and use the net to actually settle the IHT. So they're getting 2 bites here. They're getting the 20% IHT plus the potentially 38% income tax on the dividend.
Yeah, and we'll certainly come on to that in a minute. The other thing that's being taken away, though, is the fact that AIM shares, which currently qualify for 100% relief, will only ever qualify for 50% relief and cannot be used within that £1 million exemption. And I know you've got some views on this.
Yeah, I think the issue has always been that financial planners have used this fairly regularly as an exceptional tool for creating, turning cash into, by creating a really good quality AIM listed portfolio, you're effectively creating an exemption for what used to be cash into an IHT free asset.
And it only takes 2 years. It's not like having to give it away where you've got to wait 7 and 5. So
the big issue has been a lot of these AIM companies are ambitious, fast growing companies. And I suspect that what you'll see is that there will be a lot of money exiting the AIM market rather than going into these businesses that need it for growth. A lot of companies go on to AIM to raise capital so they can expand, they can employ more people. Whereas if the money's trying to flow the other way, it's going to become more problematic. And I think it will actually impact the wider economy.
Yeah, this is a shame, but I mean, it's still 50% relief, which you're not going to get on other investments. So if you're just holding cash, then you're not going to get any sort of relief on that. I guess, I don't know. We'll see. I think Toby and I disagree on this one. Okay, so what is the impact going to be in real terms? Let's have a look at a worked example. If you have got shares in a trading company worth 5 million, the current IHT liability on death is 0. That's assuming that there's no accepting assets within that. From April 2026, you are now going to be paying or your family will be paying £800,000 on that. They can pay it at 80 grand a year, but it is still £800,000, which is a lot of money. So,
and as I said earlier, if you're looking to fund that out of the profits that are made by the company, that 800,000 is really 1.3, 1.4 million after you've paid the tax on the 1.4 you've taken out. You're left with the 800 settled tax liability.
Indeed. So there's double taxation on this, which is a shame, unfortunately.
A cruel and unusual punishment.
Cruel and unusual punishment, indeed, indeed. On top of that, we have got the issue of what happens if you don't want to pay the tax. You can't extract the money from the business. So you could sell the shares, but there's not always a market that exists for the shares. So ultimately, that could mean you end up liquidating the company.
Yeah.
And that's a real shame. If we start seeing small businesses liquidating just to pay their inheritance tax or so their family can pay the inheritance tax, that's going to be a real shame. And I think that will have a real impact on the economy.
Yeah, and I think what you'll find that there will be a lot of cut price deals for curious businesses. I think that you'll be in a situation where they will have to sell the shares, but because the limited market exists, it'll be a bit of a fire sale. Corporate financiers will be busy, but I think a lot of them will be frustrated that they can't find buyers for all of the opportunities that they're presented with.
Absolutely. Now, we've not looked at APR particularly, but you just need to realise that these situations are similar for these. Again, there's been a lot of news from Mr. Clarkson about what is going on in that world. But again, the rules are similar, as in that it's the first 1 million and then it's 50% relief. And the same issues are there with what families going to do when they can't afford to pay tax.
The difference is obviously if you've got a farm, then you can't just sell it to somebody else, because in many cases that would also leave you homeless, because farms, unlike trading businesses, are a whole life as much as they're where you live, they're where you work, they're where you make your money.
So we have a lot of sympathy, unfortunately. So we have been looking at what can be done, and we've been chatting to a lot of our clients over the last few months about this. So
I think we need to precursor that there is no silver bullet here.
There's no silver bullet.
Making the best of a bad lot.
Absolutely. So we are looking at the different sorts of planning you can think about doing. And in certain cases, there's not a great deal of time, considering that when the changes are coming into effect. So, of course, the most basic planning that's ever been around is just to give everything away. And as long as you survive 7 years, then there's no IHT payable on that, assuming nobody changes the rules in the next few weeks. So that is the most basic sort of plan you can have, but it's not always practical, because if you give that away, you've got to give it away. You can't keep bending, you can't give your home away, for example. Equally with a business, you can't keep the business away and then keep drawing a dividend, because it's not yours anymore. So it's whether or not you can afford to actually make that gift. On top of that, if you don't survive 7 years, then your family are going to have to look back, because the new rules, the new BPRs rules will apply if you pass away after the 5th of April 2026. Now, we've been doing a lot of work with other firms around the city who are looking to insure this 7-year risk. So that's becoming more popular. And there's some interesting ideas out there. There's also, for anybody interested, again, not quite on this topic, who are looking at leaving and going overseas, there is also insurance available for the 10-year period while you're overseas. So if anybody is interested in that, please come and talk to us, because we know various people who are helping our clients on that matter.
I mean, I wonder whether, I mean, we've certainly seen in Norway, when they introduced wealth taxes, there was a mass exodus of the super rich, to the point where the economy started to struggle and they introduced an exit tax. So there
are a lot of rumours about that.
Yeah, well, exactly. So the idea of legging it overseas to avoid the inheritance tax problem that's been created here may not work.
Yeah, fair enough. He's quite right to point that out. Okay, so if you are going to give away your business, though, we need to also think about capital gains tax. Now, in most cases, if it's something that would have qualified for BPR anyway, it will almost invariably qualify for something called holdover relief. So that means you can defer paying the capital gains tax by shifting the base costs into the hands of the individual accepting it. So ultimately, if they then go on to sell the asset, they will pay capital gains tax on your gain as well as their own. But it's the loss of control and the loss of the income that most people can't.
And also for some of our older clients, you know, their planning has been based around there's going to be a capital gains tax-free uplift when they die to whatever the market value is, and there'll be no inheritance tax payable on it.
If you give it away and you have a holdover claim, you cannot do that, unfortunately. So while giving it away is a very simple option, which most people can do, you still need to take advice before you do it. And it's worth having those conversations before you jump down that route. So especially if anything happens within 7 years when the BPR still needs to be reconsidered. And worse still, if you gave it away today and then your family decided they were not going to run the business and it stopped qualifying, they'd sell it, for example. If something happened within 7 years, when the tax kicks back in, there's no BPR at all. So it's just normal tax of 40%. So again, that's just something to be aware of. The next piece of relatively simple planning you can look at is making sure that you understand who is going to get what and when. Now, we've already said that the £1 million relief is not transferable between spouses. So that means that if one party, for example, has got all the shares and they leave them all to the survivor and they're more than 1 million, then you are going to have wasted that first £1 million relief. So we have to think about how the wills are structured and who owns what. So there is There's a lot to be done around in a married couple, for example, or civil partnership, who owns what, making sure you've got a division there, and making sure in the wills that, for example, on the first death, you may want to make sure that the first person has used up at least 1 million when they're giving it away to the next generation, rather than giving it to an interspousal, because you don't need the relief when you're giving it to your spouse.
And I think that that's the point. It's making sure that in most cases it will be better for both people to have some shares in the company.
Yeah.
But if that's not the case now, then you've got this 2-year ownership.
That is not, you need to make sure that the person who is acquiring shares, for example, meets their 2-year ownership period, because if they don't, the BPR won't apply anyway. So you've effectively got a 2-year exposure period, which you need to worry about.
And again, I'm sure the insurers will come up with something whizzy around that.
Let's hope so.
When they spot the opportunity, they usually do.
Okay, so we're now going to look at the slightly more complex areas of planning in detail. So we look at trusts and then restructuring your shareholdings. So setting up a trust pre-April 2026. Sounds like a great idea. We've been talking to a lot of clients on it, but there are some health warnings on this one because there are already transitional rules in place, and they're also, trusts are complicated. It's not the sort of thing you go into, it's not for the faint-hearted. If you're not used to them, you should definitely talk to somebody before you think about settling one.
And I think generally, to be completely honest, by complicated, we also mean in most cases fairly expensive. It's not going to be a minor level of professional fees to get this all configured.
Correct. Unfortunately, that is the case. So let's think about what some of the important things you need to do to make sure a trust like this will be effective, though. The important thing is any trust you settle must not be settler interested. So like with giving away shares or your business, once it's in that trust, you cannot benefit from it anymore. You must stop benefiting from it. So you can't benefit from it. You can't get money out of the trust because your kids get it paid out and they decide they're going to gift it onto you. You just can't do things like this. So any trust has to exclude yourself, your spouse, and any minor children, so kids under 18. Yeah. Grandchildren are fine, but your own minor children you cannot include if you want to avoid it being settler interested. Now, again, on the way in, capital gains tax may be payable because if you put something into a trust, it's treated as a disposal, so it's capital gains tax, but you can hold this over. Now, all assets going into trust can be held over, but like Toby said before, no uplift on death, which is not necessarily helpful, and it may muddy some of the previous planning you've looked at. BPR is still available today if you put an asset into trust, but you need to be very careful about what you are putting into trust in case they're accepted assets. BPR does not apply because there are assets within the value that don't. So for example, use your example, we have shares in a trading company and then there is a property, a residential property sitting in that trust. Yeah, that will be accepted, even if it still qualifies for BPR, that will be an accepted asset. So on the way in, you are going to get a 20% charge on the value that isn't covered by the BPR potentially.
Yeah, so that'll be 20% on the property.
Subject to the use of the 325 grand going in. So whether that's available, and it depends whether you've settled other trusts.
And again, this becomes a structural issue. Do we try and take that out? Do we try and restructure that away? So to make sure that we've not got this potential exposure going forwards.
Absolutely. So again, you need to think carefully about values and structure before it goes in. But effectively, you may be able to arrange it so there is no entry charge on settling an infinite amount of business property relief qualifying assets into a trust, providing you do it before the 6th of April 2026. And then there will be no IHT payable on that particular transfer, providing that the settlor survives at least 7 years. Now, if they don't, then tax has to be recalculated again, and it will be under the new rules. The new rules with only 50% BPR on the excess over $1 million. This is quite interesting planning. We do this sometimes though for when people are planning on selling a business. This is kind of outside of the scope of today's seminar, but it is worth looking at. But you have to watch the timing again because of the way the 10-year charges. Yep. Outside of the scope of what we're talking today, but if people are thinking about selling a business and want to look at getting things to trust, come and talk to us because we may be able to help on that score. So new rules will apply if the death happens within 7 years of transfer, because yeah, it's just how it's going to work. If it happens after 2026, the new rules will apply. You may still be able to get taper relief, we've discussed before. So again, if you made a significant gift in, taper relief may apply once you've kind of calculated it if it's more than 3 years. Again, insurance is going to be key. Now, trust will pay tax under the relevant property regime thereafter. This is not going to get the assets out of inheritance tax forever. It's just going to shift it into a different IHT regime, which is what we're going to talk about now. So as we said before, inheritance tax is payable by trust or by relevant property trust. So mostly any trust that's set up now is going to be almost invariably, unless it's a bare trust, will be a relevant property trust. So those sort of trusts will pay tax on settlement, as we've just discussed, which is 20% for non-BPRable assets. Going forward, our understanding is that when BPR assets post April 2026 are settled, then it will be a 10% entry charge, although again with the first 1 million IHT free, and then your usual allowance is 325,000. You've then got something called the periodic charge. A trust pays inheritance tax every 10 years at the 10th anniversary or 6 months after the 10th anniversary. Now, at the moment, this is after you've taken into account your allowances, the excess is chargeable at 6%. And that's non-BPRable assets. Our understanding is that going forward, that when BPRable assets are in that trust, they will pay tax at a rate of 3% above the 1 million. Now, the current calculation is not an easy calculation, but it's relatively straightforward if you know what you're doing. With the way this new calculation is going to work, I suspect it's going to be a hell of a lot complicated. So it's not something I am relishing doing, I must admit, but I think we're going to see quite a lot of these, unfortunately. Well, we will, because we look after a lot of trusts. So this is not something I'm very, very
But
excited.
if you're looking at potentially a high value trading company, a 20% inheritance tax charge on death or 3% every 10 years, in simplistic maths, you need to live for over 70 years to get 7 lots of 3% before it's worse than the 20 that you pay on death. So
You have to think about value shifts. So how many times is somebody going to die? And then when you're paying the 10-year charge, you're actually paying it on lower values early on during that 70-year period, if that makes sense. So the earlier ones, as the value is growing, it's hard to explain, but as the value is going, you're paying it on a lower value rather than the death values, which will be. You would need to try and work out various things when popping the money in, what the 10-year charge is going to look like, because it's not quite straightforward as 6%. We have to think about capital distributions for the trust in the last 7 years, other trusts set up, for example, as well. There's also something called exit charges, so proportionate charge. If assets are in a trust and then distributed out, there's another round of IHT payable at that point, and that's usually payable by the recipient, though. And the rate that that's paid out will depend on the value at the last anniversary. Again, it will be up to 6% or up to 3%.
yeah.
And each pro rata to take into account the time that's elapsed. But in short, it is relatively complicated, my screen. Bear with me. Aha, thank you, Toby. Right, okay, so the transitional rules that you need to be aware of, we've already alluded to. Now, these will apply to trusts that have been set up since the budget. So the last budget was on the 29th of October, 2024, and therefore there have been changes. Anything that happened after the 30th of October, you need to think about whether or not you will actually get all the relief. So, as we already said, until 5th of April, you will qualify for 100% relief when you're making the settlement. But if death happens within 7 years, then the new rules would apply. Trusts settled previously to that don't necessarily have to worry about the new rules applying within that 7 years. These are not going to be retroactive. Existing trusts, so trusts at pre-October 2024, will automatically qualify for the first £1 million relief. So even existing trusts will be affected by these rules, but not until after their next 10-year anniversary.
Yeah.
So as long as you've got like a 10-year anniversary before the 5th of April 2026, you will continue to benefit from the old periodic charge rules and the old 10-year charge, so exit charge rules. After that, rules are going to change. So existing trusts will get their first 1 million when they calculate their 10-year charge, whereas new trusts might not. It will depend on what other trusts have been settled around the time or what else is going on. So again, quite complicated. And the new rules again will apply for the first time. So when the existing trust hits their next 10-year anniversary, they will need to take into account all the new rules, unfortunately. If you've got an existing trust, you've not done anything with that, now there are still some opportunities to perhaps think about moving things around between now and the next 10-year anniversary. So definitely take some advice. Right, okay. I'm going to move over to you. Talked about family investment companies. These are definitely flavour of the month at the moment.
Yeah, I mean, it's a popular alternative to using a trust, and essentially it's become a bit of a catchphrase. A family investment company is just a company. The reason it's described slightly differently is because most companies will have ordinary shares, and many companies will only have ordinary shares and no other shares. A family investment company will often have many classes of shares. For instance, there will be shares that, A shares, B shares, C shares. And because a share effectively entitles you to vote, it entitles you to potentially a dividend or the underlying capital. And the FIC is slightly different in the fact that What a lot of these do is they separate those various rights and upsides. So some shares will have votes, but nothing else. Some will have dividend rights, but nothing else. Some will have capital rights, again, nothing else. Some will have 2 out of 3. Some will have all 3. But the general consensus is it's a way to prevent the future growth in value of the company falling into the hands of somebody who's likely to bear inheritance tax on it. The most popular way of configuring these things is simply,
Sorry.
the most popular way of configuring these is simply the parents often will set this up and put the initial capital in. They will have no rights to any growth in capital, but they will have a right to recover that capital if they've put it in as shares. Often it's put in as a loan, and there are a few party pieces that can be done around that using a loan to fund the initial one. But essentially, what you'll have is any growth in the value of those shares moving forwards falls into the hands of children, grandchildren, nieces, nephews, whoever you like. The one thing you have to be very, very careful about here is if you have minor children, they should not be subscribing for shares with money given to them by their parents. Children are absolute masters at shaking down grandparents for cash, aunts and uncles too. So if you need £5 to buy your, little Johnny who's 6 needs to buy his growth shares, then he shakes down grandma for a fiver rather than asking mum and dad to do it, simply because if it's bought with money that's provided by the parents, it all comes back in a circle and ends up being taxed on the parents.
Absolutely, well. Yeah. The settler rules, and mum and dad become taxable on it. These are often seen as a modern version of the trust because you still retain control.
That's this thing. In a lot of these scenarios that we've set up over the years, mum and dad own all of the A shares, so have all of the votes. They have all of the seats on the board, so they are in complete control.
Almost like a trustee.
Yeah, absolutely. And then depending on their future income and capital needs, they may retain an interest in the dividend streams.
That's a lot better because with the trust, you can't have that income, at least with this structure.
Yeah, you can have the income. You can have some or all of the capital if you want it, but again, it will slightly undo the purpose of this, which is to transfer that capital growth into somebody else's hands.
Importantly, you're not transferring the initial capital out at this point, are you? No.
Effectively, you're capping the exposure at today's value.
Yeah, which for some people is very important. So, for example, if you've got a business that's currently worth £1 million a day and you don't want to grow beyond that million because you want to make sure you're covered by BPR.
Well, no, you absolutely want the business to grow beyond £1 million, but you don't your estate to grow beyond £1 million. So it's putting it into the hands of others. And then, the one thing that this can do is you can use it on existing companies, whether they're investment companies or trading companies. It doesn't solve the problem of the current capital value, but it will solve the problem of future capital value being subject to inheritance tax on that first death, as we like. Again, you can transfer value in this way without triggering tax charges, but the valuation becomes absolutely critical. So if you say, oh yes, I want to cap my value at £1 million because that's what I can get tax-free under the BPR rules, how sure are you that that company's worth £1 million? What if it's worth 1.5? And there's actually, we've looked at this, and there's a scenario in which you could potentially end up in a situation where the parents, as the directors and sort of controlling shareholders, end up with an employment-related securities charge, which was an income tax charge at their maximum rate if you have effectively transferred value out of and then back into their hands.
Which is problematic because that could be even more than the inheritance tax would have been.
Exactly, and that will undo all of our good work here. And again, the simplest family investment companies are basically mum and dad put a bundle of cash into a limited company. Yeah. That initial cash is ring fenced, but the growth in the value of that, depending on what's done with it, goes elsewhere.
Yeah, and you can use this sort of businesses, you could use it property as well. But importantly, we get a lot of calls from people who would like to put their existing property portfolios into a company and to do this kind of thing. That's much harder to do without triggering taxes all over the place. And more importantly, it doesn't solve the inheritance tax issue because all you've really done is swap your property portfolio for shares in a property portfolio company, and you're still going to have to give them away 7-year-olds. You're still going to have to deal with the capital gains tax. So this can be a really, really good solution though for businesses. And it can be a really good solution where there is cash kicking around ready for investment.
Yeah, I mean, you're talking that investment property scenario. One of the key things is you can stop the problem getting any worse.
And that,
Given the likely direction of travel in taxation, which is upwards, then stopping the problem getting any worse before the tax rates get any higher is actually a preventative measure. And also, in some cases, when you're talking to the insurers about insuring potential IHT liabilities on these things, having that liability capped will be appealing to the insurers.
okay, then. So we've touched on it a little bit,
Mm.
but as part of a lot of this, if you want to start moving your assets or your businesses into trusts or into a FIC,
Yeah.
then valuation is going to be highly important, as it is on the death of somebody who hasn't even done any planning. So
Yeah.
tell us more.
We've been largely overrun with requests for valuation simply because what we're seeing now is managing the situation is going to get worse before it gets better. People are looking to value their businesses so they can transfer them into trusts, so they can give away shares. Because at some point, if you give away shares now, you may have to look back 7 years. It's much better to have a value now than for someone like me in 6.5 years' time to try and work out what the company was worth today.
It's surely much more expensive to do it later.
It's trying to get access to the data that was available at the time and trying to get the level you need to be able to do a proper valuation is challenging.
Of course.
So what we're finding is there's a lot of people who are looking at it to try and understand what their inheritance tax exposure will be under the new rules. There's a lot of people looking at it from, I want to put some shares into a trust. Yeah. There's a lot of people thinking, what else can I do? If I've got shares that I can't get a CGT holdover when I hand them home, what's my exposure? And it's CGT versus IHT type conundrums there as well.
Yeah.
It used to be that the business valuation was usually the preserve of, we want to grant some share options to employees was the one that, was the daily bread and butter, whereas this has become so big so quickly that actually that started to fall away. Okay. And one of the key things is that if you set up a trust, the trustees have a responsibility to ensure that they know what they have and what it's worth.
Got to register it on the TRS for a start.
Yeah. And if you don't know, or you overvalue something, or you undervalue something, and in some cases, it may be worth paying the tax on an overvalue or undervalue if you can make sure that that's subject to capital gains tax and you would get, the business asset disposal relief on it. On the other hand, if you're going to generate an employment-related securities charge, which is just another type of income tax at 45%, and potentially, if you get it wrong, with employers and employees' national insurance at their new even higher rates applying, you can lose 60% of the transaction value to the taxman on the overvalue or undervalue.
Okay, so that's nasty. So how do you do it? How do you value business then?
Okay, so generally the businesses are split into two types. There's trading businesses and investment businesses. Trading businesses, what you would normally do is you would use a multiple on adjusted EBITDA. And the first thing is a multiple. These are price earnings ratios. Every listed company has one. And generally we benchmark against those listed companies doing similar things. In many cases, it is difficult to do that because a lot of small businesses, there isn't, Joe Bloggs Limited, small business, Joe Bloggs PLC doing exactly the same thing, just on a somewhat grander scale with a stock market listing. So we're having to try and link it together. And the other thing is you will apply a discount to those because if I'm invested in Joe Bloggs PLC, I can phone up my broker and say, I don't want those shares anymore, and they'll be gone in minutes. Quite frankly, I'd probably do it on my phone while I was thinking about phoning a broker.
These days?
Yeah, well, indeed. So there's something to do on the train, isn't it? On the other hand, if I own shares in Joe Bloggs Limited, a small private company where there are only two other shareholders, the likely buyer for those shares is probably going to be one of those other two people, assuming they have the funds to do it. Assuming the articles of association allow it, then there's preemption rights, drag-alongs and tag-alongs and other things that you normally find in private company legal setups that need to be considered before you can do this. But you can come up with a multiple that works. I say adjusted profits simply because some companies, minor children receive payment as a salary.
My dad never paid me.
No, my mum didn't me either, so I actually had to get a job, which was disappointing. But you've got non-working spouses who are often employed, and Yeah, and the
Working
thing,
in the business.
yeah, and the one that's most popular again is you're looking at this from what would an unconnected investor pay for the business. If you've got directors who are taking dividends, that's not reflected in the metric of profits that we use. So if you're taking out £100,000 worth of dividends every year, we make an adjustment to say, okay, what we'll take that out. What would a market value salary be? Because if I want to be a passive owner of this business, how much do I need to pay to get somebody to run it for me? Investment businesses are slightly different, and the actual crux of that becomes what are the underlying assets worth? If I've got a property company, how much are the properties worth? What is the rental yield compared to market? If I've got particularly premium, tenants in my rental property, I might tag a little bit on if it's very profitable. But again, you'd probably take out, you'd sort of add up the value of the assets, you'd knock off the liabilities, and then you work out some measure of profit to make an adjustment to that as well.
Okay.
But it's that family companies, traditionally, there will be payments that are not always entirely necessary. The company may not be of the type that you would give to an employee doing that job. It may be that there's a company yacht, company helicopter. I've seen the company helicopter. That was a fun one. But again, these I come basically the benefit in kind on a company helicopter works out at 20% of the use value. So it's actually cheaper for the company to get the capital allowances on it than it is to. It's a huge benefit in kind. Anyone thinking of buying a helicopter, probably don't put it through the company.
Either way, though, what you're saying is there is a science to valuations, but presumably there's an art to it as well.
I could present the same data pack to three valuers, give them the exact same data that I can guarantee that the one thing that they would not do is come up with the same number.
Fair enough.
There would be three different values.
But hopefully something like
that. I would imagine they would all be within the margin, as it were, but I don't think they would be the same. So again, it's looking at values. And what we're going to see coming back is because there's so many different ways to value, and it isn't an exact science, and it requires a bit of knowledge, experience, and in some cases artistry. Yeah. That we will probably see HMRC go, we don't like your value.
And we are seeing more and more of these on trusts, for example, just as a kind of a side note, we are getting a lot of valuation queries on even properties. We've got red book valuations, but HMRC are after every penny they can get at the moment, unfortunately. Yeah. And so when we are doing these 10-year charges, it's very rare for us to not see any query over them now. Yeah. And thinking of queries, I think, is there anything we want to add at this point, or are there any questions from the floor? Justine tells me I've got some questions, so I'm hoping she's going to
read questions.
Right, okay, you want to read them for me.
So the first one is, can you please also comment on whether there are additional BPR/IHT risks around large excess cash balances on the balance sheet?
Absolutely, good point. If you've got a lot of cash sitting in your business, then it's highly likely that this could be treated as a non-business asset unless you're earmarking. Now, we talked a bit about this, we should cover this earlier. You need to be earmarking what that money is for, because if that money is not for the business, it's not going to be used for the business and just is being accumulated. Yeah. When you are looking at this, there are two risks to it. Firstly, if you are trying to establish whether or not the business qualifies for BPR at all, because if you have got a large balance in there and it's enough to make the 50-50 test fail, then you could lose BPR on the whole lot. Alternatively, if the business is still sufficient enough to pass the wholly or mainly trading test, then it could still be treated as an accepted asset. Now, we've seen a lot of clients with this, and we work with them to make sure it's documented.
Yeah, and again, it's absolutely fine for a company to build up a war chest, but you need to document what it's for. Yeah. I've got a client who builds up multiple millions, but they will go out and buy businesses with it. They will go out and buy assets for expansion. But all the time they're saying, okay, we've got this large mountain of cash. We're not using it right now, but this is what we're intending to do with it. This is why it's being accumulated.
And that's important, but it's not easy for every business to be able to do, unfortunately.
And what you find is a lot of property developers fall into this trap as well, because they will let out a property after they finish building it because market conditions aren't right. At which point HMRC will turn around and go, well, this is a property investment company because it's letting out properties. And at which point, if you haven't got the documentation that says, we've finished building this, we want to sell it, we're intending to sell it, we're trying to sell it, but market conditions are preventing us from doing this, so we're taking a short-term income. But it's making sure that all this is written down. And the best place to put it is in the company board minutes, and just making sure you've dotted your I's and crossed your T's. So if HMRC come, and they may well do, we've automatically got something to push them back with.
Indeed, indeed.
Next one, in your opinion, which of these tax changes are not ideal and why?
The tax changes in general are not ideal because we think we are seeing a lot of problems, unfortunately. When your tax planning involves well, I'll be much better off if I don't survive beyond the 5th of April 2026 than if I do survive beyond that. That's not ideal. That is not something we ever thought would be something that the government could introduce. And there are already some very sad stories, certainly in the farming community, where people have been thinking about that and taken action, and that's not okay. So I don't think any of them are ideal, actually.
So solving an inheritance tax problem by accelerating somebody's ability to receive their inheritance is not the way to go. I mean, it's a sad state of affairs. I mean, I think for me, it's the concern that family businesses may have that where there has never been any previous intention to sell these will have to be sold to fund a tax bill.
And that's not right.
And I've my clients and I, we have a lot of conversations, and that is a real concern for them because their businesses have a culture. They are family businesses, and in some times the employees are part of that family. Selling out to a third party who wouldn't treat them that way is going to be a very painful experience.
Yes, agreed.
Can you transfer shares in a trading company into a FIC without a CGT charge?
It depends who owns them and how you want to do it. Generally, there are restructure provisions that allow you to make share-for-share exchanges. There are also one or two other reliefs that can be done. It would depend on the specific circumstances. It may be possible, but by default, if you personally own shares and you put them into a FIC, you are going to pay tax on it, unless we can get benefit from some of these restructure provisions.
And surely at that point as well, you've not really achieved anything because you've still not passed the value on to the next generation.
If you own the shares and you think they're going to climb in value, you're locking in the current value and passing on the growth. So it's definitely possible. But it needs a bit of thought, because what you don't want to do is to walk into an unexpected tax bill. By default, you would gift those shares, it would be treated as a disposal not at arm's length, and you pay the tax as if it was done at market value anyway.
Indeed.
Can Alphabet grossing up shares be set up for existing company, and do you need to carry out any valuation or need any HMRC approval?
You don't need HMRC approval to add classes of shares. You do need to check very carefully. The company's foundation documents actually allow it. I don't think that by default the standard articles of association allow for it. They just talk about ordinary shares. But yeah, we can certainly do it. It requires a bit of work. And yes, you would absolutely need to value anything, because if you are trying to give away the future growth, you need to know what it's worth today. And usually we would leave a margin. So for example, if the valuation comes out at £1 million, we would give away, any value over 1.1. So that gives you a little bit of headroom. So if HMRC do take the argument and you go, okay, it was worth, £1,050,000, then we still haven't hampered those growth shares, because the key point with the growth shares is by excluding the existing value makes those shares almost worthless on day one. So we keep the par value down. So somebody can say, I'm going to buy 50% of the growth for 10 quid because it's not worth anything right now.
It's hope value, isn't it?
Yeah, it's hope value. And, HMRC and us have never really reached an accord on what is hope value worth.
Nothing.
And we're accountants. We're naturally pessimistic. The future is hopeless. Things are not going to get any better, and therefore, it's advantageous to say that hope has no value simply because it caps the value of the shares at today's price.
Indeed.
Another 7.
Oh, we've got lots more questions coming up. There's another 7 apparently. What we will do is, if you have asked a question and we haven't managed to answer it, if you can send us your email address in the chat, I'm hoping they're all in the chat anyway, then we will come back to you and follow up, and we'll arrange calls with anyone who would like a chat. But thank you all so much for listening today. If we can be of any help, do get in contact. Our contact details will be circulated along with details of our next presentations. We look forward to seeing you again very soon. So have a lovely day, everyone. Take care.